Bitcoin and crypto market edge up 4%, following Fed's 0.25% interest rate hike. Do you invest in Bitcoin and cryptocurrency? Then you should know about the recent news in the cryptocurrency market. Hey there, and welcome to another video on Altcoin Capital. Make sure you leave a thumbs up, smash that subscribe button, and hit the bell notification so you don't miss out on any upcoming videos. Now let's jump right back into it. Following the Federal Reserve statement on Wednesday that interest rates will be raised by 0.25%, the first since 2018, the cryptocurrency market and Bitcoin in particular rose by almost 4%. According to CoinMarketCap, at the time of this writing, the whole crypto market and Bitcoin surged to $1.83 trillion and $41,204 respectively after the news. If we think theoretically, we can expect that if the interest rates are higher than the crypto market would go downward because of the fact that investors will tend to conventional investments for more safe returns than the crypto market, which is volatile and way riskier. But ever since the Fed announced 0.25% increase in the interest rate, the Bitcoin and overall crypto market rose by 4%, opposite to the fact that on 26th of January, the price of Bitcoin fell by 6%, falling from 38K to 35.6K, just because of the fact that the Fed Reserve convened and discussed the hike. But now analysts are optimistic that the Bitcoin and crypto market will remain resilient to the rising environment of the interest rates, which Fed is expected to increase to 1.9% by the end of 2022 through 6 rate hikes in the year. So opposite to the conventional hypothetical thinking, where we may be expecting Bitcoin to fall down due to an increase in interest rate, which will make investors to move out of the crypto market and move towards the conventional market, has proven wrong by the market. And during recent years, when the interest rates were hiked, the Bitcoin maintained its momentum of growth and was never negatively affected by the interest hike. There had always been some rises in interest rates in 2015 and 2016, and there were 3 interest rate hikes in 2017. There were 4 hikes in interest rates in 2018. What we have seen though in these interest rate hikes is that Bitcoin has been on a whooping 2,000% interest hike, and during these interest rate hikes, Bitcoin reached its $20,000 advance. So here's how the crypto market is embracing the rate hikes. Considering the current market collapse, the jump in March and following rises might substantially influence Bitcoin and the entire cryptocurrency market. As an example, by the time the Federal Reserve convened on January 26, BTC had dropped from around $38,000 to $35,600. This was a 6% drop in less than 24 hours, and it was a big one. Since the Fed's December 14 to 15 minutes were posted on January 5th, it has been clear that it intends to raise interest rates in 2022, which has a negative effect on Bitcoin and other cryptocurrencies. Bitcoin, or BTC, fell from $46,500 to $43,200 in hours after this article was published, before falling to $41,500 a few days later, a 10% drop. Bitcoin and other cryptocurrencies have been on a long-term downward spiral since its publication on January 5th, with the cryptocurrency market shedding 21.7% of its value. Since the Fed has been steadily becoming more aggressive, it has had an impact on the cryptocurrency market by dampening investors' expectations of a more restrictive monetary policy. The increase in the interest rates being discussed for 3 months now, and investors knew that there is going to be an interest rate adjustment. Though the chance of such an event exists, it is impossible to determine for sure how probable it is. Supply shocks are primarily responsible for the present macroeconomic volatility resulting from the continuing COVID-19 outbreak. Issues like these might be resolved in the coming months, which would lead to lower inflation and, therefore, less willingness by the Fed to raise interest rates. Currently, The Fed plans to raise the federal funds rate 3 times by 0.25% each time, bringing it to 1%, compared to the 2.4% effective rate in July 2019 and the 19% effective rate in 1981. This isn't huge. Some experts predict that rate increases will boost Bitcoin, if not other cryptocurrencies. Analyst Mike McGlone wrote in a Bloomberg Intelligence newsletter on January 11th that a 1% interest rate increase may support a win-win scenario for Bitcoin versus the stock market, citing its limited supply and the fact that it is in its early adoption days as the reason why Bitcoin will fare better than equities. Why is the Fed raising interest rates? According to Federal Reserve Chairman Jerome Powell and other Fed officials, a 4-decade high in U.S. inflation rates necessitated tightening monetary policy for months. As the COVID-19 epidemic fades, it's also evident that the employment market has almost fully recovered. The Fed is tasked 2 tasks by Congress: maintaining price stability and promoting full employment. Fed's tightening monetary policy looks to be the next step now that the Fed's task on the latter appears to be completed. During the March meeting, when we say raising interest rates, we mean increasing the federal funds rate by 25 basis points from 0.25% to 0.50%. Though it's the first move, analysts estimate that the Fed will raise interest rates 6 more times in 2022 and bring the Fed funds rate to 1.9% by year's end. Interest rates can lower inflation, which in turn can increase the risk appetite. According to statistics issued by the U.S. Bureau of Labor Statistics last week, the Consumer Price Index rose 7.9% in February, the highest level in 40 years, and the 10th consecutive month that it was greater than 5%. As if the inflation goes down with the higher interest rate, we can expect people to take more risk because now we can see stress on pockets due to higher prices, but once prices go down, we can expect people to go for riskier investments like cryptocurrencies. According to a statement released by the Fed's Federal Open Market Committee, or FOMC, on Wednesday, Russia's invasion of Ukraine and continued conflict might increase short-term inflation. Many people and businesses have been affected by Russia's invasion of Ukraine. The long-term impact on the U.S. economy is difficult to predict, but in the short term, the invasion and associated events are expected to put extra pressure on inflation and reduce economic activity, the text of the FOMC statement said. Number 1. Fed rate rises have an impact on stock prices. You must be thinking about how these increased rates could affect the wallet. The stock market's reaction to a rise in Federal Reserve interest rates is nebulous. On the one hand, increased interest rates may entice some investors to cash in on their gains and liquidate their holdings. However, there is enough evidence that rate rises do not harm equities in the long run. A rate increase's most direct effect on the market's psychological state is its short-term impact. When the Federal Reserve increases interest rates, experienced traders may swiftly sell equities and switch into more defensive assets without allowing the complex process of higher rates to work its way through the economy. However, long-term evidence demonstrates that the stock market may gain while the Fed tightens its monetary policies. Dow Jones market data looked at the stock market's performance over the 5 most recent rate rise cycles to see what the past tells us. According to their data, the 3 top stock market indices fell just once throughout these 5 long-term periods, during the dot-com meltdown from June 1999 to January 2001. Hey, don't forget to hit that subscribe button and leave a thumbs up and a comment below. Number 2. The cost of credit card interest continues to rise. Whenever the Federal Reserve increases its benchmark interest rate, the cost of your credit card debt goes up. Another way, the interest rates on consumer debt, such as a credit card bill, tend to rise and fall in tandem with the Federal Reserve's interest rate. Commercial banks use the federal funds rate as a benchmark for short-term loans. An increase in the federal funds rate indicates increased borrowing costs, reducing the demand for borrowing money by banks and other financial organizations. The interest rates banks charge for consumer loans rise due to increased borrowing costs. Your APR will be based on the prime rate, the interest rate banks charge their least risky customers when they lend money. All major credit cards impose a variable APR based on the prime rate plus a percentage to pay operational expenses and profit margins. To qualify for a variable rate credit card, you must agree to pay an interest rate that is subject to change depending on the prime rate. So if your credit card APR is 16.25% and the Fed raises its federal funds rate by 0.25 of a point, your issuer will probably hike your APR to 16.5%. To put it another way, the more interest you pay on your credit card debt, the more costly it becomes to service it. Using a 0% APR balance transfer card may help you save money by reducing the interest you'll have to pay on your existing debt. Number 3. The cost of home loans and mortgages is increasing. Borrowing money for a house and other loans becomes more costly when the Fed raises interest rates. Rates for 30-year fixed-rate mortgages rose by 9 basis points last week to 3.85%, according to the most recent Freddie Mac weekly data. A tightening of monetary policy raised by 10-year Treasury yield, which directly influences mortgage rates, but not the Fed funds rate. Adjustable mortgages and home equity lines of credit will certainly climb as well. Individual lenders, asset types used to secure the loan, and your credit history all factor into the interest rate offer you get. There is a chance that interest rates on private student loans linked to the Federal Reserve might climb. Make sure you understand your debts and think about refinancing them before interest rates rise more. Number 4. Increases in the federal funds rate are beneficial to savings accounts eventually. There is good news for savers, but it may be some time before bank savings receive increased interest rates. Deposit rates are not directly linked to the federal funds rate. Banks ultimately raise the annual percentage yield, or APY, for savings accounts such as money market accounts and CDs. Banks ultimately raise the annual percentage yield, or APY, they pay, but not immediately. Typically, banks boost interest rates to attract new customers, but they might be slow to increase yields when they have a cash surplus. Depending on where you bank, you'll notice greater APYs on your deposits sooner or later. Smaller banks, credit unions, and online banks often offer greater interest rates than larger banks since they have to compete for deposits more fiercely. If you're seeking a greater rate return, an online bank or credit union may be the best option for you. As of February 22 of 2022, the national average savings account interest was 0.06%. Yet, some of the greatest high-yield savings accounts paid 0.50% APY when inflation is on the rise. Where you keep your money matters more than ever. But Bitcoin and crypto can at the same time give you way more returns, but at the same time are volatile and riskier. Also, if you liked the video, give it a thumbs up and don't forget to share it. We will see you on our next video.